Iran is not a country like Venezuela which can be controlled very easily. They're not going to back down now. Obviously, then Israel and US are on the back foot. If US decides to sort of send troops there, then this sort of escalates to a much larger level where even Russia might get involved, and suddenly then we are potentially looking at World War III.
The US is still not the biggest economy, not just the biggest economy, also the biggest technology superpower and the biggest military superpower. And what goes along with all this is also the biggest media superpower. In terms of ability, it is very difficult today to frame the world in terms of old framework like US is on one side, Russia is on the other side. I personally think that it is multipolar, and also some of these relationships are quite complex. They are not as black or white as what it used to be in the past. Compared to 100, 203 years, 300 years back, economic interests are kind of ruling supreme, and the world is dominated by economic interest and dominated by corporate interest. But I think that this is a great starting point, because I think from here, anybody with next 5 years kind of horizon stands to make very good returns.
Hi guys, welcome to Aspro's another podcast, and today's topic is very sentimental right now. A lot of things are happening in the markets, a lot of news you're seeing, and it is creating a lot of confusion for a lot of people. And today we have Aashish Somaiyaa with us, who's Executive Director and CEO at White Oak Capital India. And I'm pleased to tell you that White Oak Capital roughly manages close to $4 billion worth of funds for Indian investors. So, hi Aashish, welcome to the podcast.
Thank you, Vishwas. Thanks for having me.
Great. So Aashish, I think no better guy than you to sort of give us clarity in the times we are right now. So I'll straight away, address the elephant in the room, which a lot of people are wondering from not just past 2-3 months, but maybe from last 1 or 2 years, because market has largely been sideways.
Yeah.
Right? Now, people are sort of confused that a lot of geopolitical things have happened, a lot of internal conflicts have also happened, right? Then why is India showing so much resilience that it is not sort of seeing that, I'm not saying a crash where like markets completely, turn red, but they have also not seen a very major downfall where, let's say, the markets have gone back to 22,000 or 21,000. They're stuck at the levels, they've again gone back to the same levels and again gone down to the same level. So why has that been the case? Why is there certain resistance, and why? Because generally in the past when we go, generally these events used to trigger a lot of uncertainty. These events used to create a lot of fear and panic in the markets. But the situations have been different. Why so?
So many layers and many nuances to your question. But first, my 2 bits, I think that on the surface level, yes, if you look at Nifty, it looks like, a couple of years back, say in August 2024, 1.5 year back, Nifty was say 26,200. When India-Pakistan had that skirmish, it went to 21,700. Few days back, I think, end 2025, again 26,000 plus. And now, say 24,000, give or take. So maybe 7-8% plus minus. Now, on the surface, it looks like Nifty is 25,000 plus minus, let me put it this way. But then, Vishwas, if you look at the small cap index, I think from its all-time high, maybe 17-18% down. If you look at mid cap index, maybe low double digit down. And Nifty itself, even for whatever it's worth, 26 to 24 is maybe 7-8% down. So, and then what happens is that if you go back to 2024, what was hot then was railway, defense, PSU, infrastructure.
Right.
Correct. So what was hot then and where is it now? So if you really look at the broader market, I think there has been a correction. But yes, you're right that it looks calm and it looks stable. I mean, there is no panic, so to speak. So that said, now, why is there not much panic? And I think there are really too many facets to this. But first thing I'll tell you that, eventually when you look at risk or volatility, the amplitude matters. Now, what has happened is that after India's liberalization, 33 years hence, you have seen, change in political landscapes. You have seen external macro, like, you've seen World Trade Center being blown up. You've seen the global financial crisis. You've seen COVID. You've seen so many things.
Right.
But what has happened is that in this entire period of 32, 33 years, when I say amplitude, what is happening is that we are consistently growing in bad times. Like COVID was an exception, but in bad times, maybe 4% GDP growth. Like 2019 financial year, I think, was horrible, but GDP growth was 4%. Correct. And then there have been times when it is between 8 and 9%.
Right.
So what happens is that overall, in terms of the performance, while you go through cycles, how bad does it get in bad times, and how good is it in the good times? And from that perspective, now for 32 years, nominal GDP growth has been 12.5%. Real GDP growth has been 6.5%. So there's a very, very long history with less volatility in terms of the amplitude. I mean, in bad times it doesn't get horrible except for maybe COVID, which was truly global phenomenon, and that too for a couple of quarters. And in the good times, it is like 8-9% kind of thing, right? Second important thing to really look at is that everything is relative. I mean, when you say why is India relatively calm, then look at it outside, and you will realize what type of cycles other emerging markets have gone through.
Right.
Correct. So if everybody is a pygmy and you're a tall pygmy, it still counts, right? The other facet of this is also the fact that we have had policy continuity, right? One thing which people always debate is price to earnings multiples. And at the drop of a hat, you must have heard people saying that India's PE multiple is high and other emerging markets are cheaper. Now, there also, what we need to look at is that while on the surface level, you might say that 20 PE is expensive, 10 PE is cheap. But these price earnings multiples, they also reflect long range visibility and sustainability, because ultimately you're discounting the future. So if something is going at 20 times, the market is telling you that whatever that growth is more sustainable. Whatever policy or whatever underlying economics you're talking about probably has more longevity and more visibility. So a lot of your viewers will be surprised to know that high PE multiples are also paid for a governance structure, law of the land, democracy, the media, all of these facets, right? So I think all of these things are playing out when we talk about stability. Last thing I'll tell you is that obviously relative to external macro, when you talk about flows and you talk about fundamentals, in both ways, I can't say insulated, but I can definitely say we are a lot more domestic or a lot more inward looking. And that also is statistically reflected, because in last few years, India's beta or correlation versus US versus China and versus emerging markets, our correlation has consistently been dropping actually. So a lot of nuances to that, but I'm not surprised if we are not as volatile as some of the external world is.
Got it. So, like you said, the amplitude word, I really like that perspective. And we obviously don't see, such amplitude events, on a yearly basis. We see maybe once in our lifetimes, or maybe we see 2 to 3 times in our lives, right? For example, like you mentioned COVID, before that it was 2008.
Yeah.
Before that it would have been the internet bubble, right? But if yes, you're absolutely right. When we look at Russia, Ukraine, if we look at the previous conflicts between Israel, Iran, or India, Pakistan, or whatever has happened, it has largely been constrained and it got resolved within a very safe period of time.
Yeah.
Right. But today, what we are looking at, and the kind of the way world is moving, right? And you especially look at this book written here by Ray Dalio, that the changing of the world order. And I would like why nations succeed and fail, right? So in that context, there is a beast called the US, right? Now, the problem with US is obviously its debt has been rising. Everybody knows that they're sitting at $38 trillion of debt. Nobody knows how that can be resolved for them. But still moving on from that. Now they have gotten themselves escalated in a region where I think they've clearly miscalculated, or they didn't want to be. And the point is, Iran is not a country like Venezuela, which can be controlled very easily, right? And now what the potential fear that people have is, because the philosophy of Iran, or let's say the way their supreme leadership works and their thought process works, they're not going to back down now. Because for them, this is much bigger than just, just a normal dogfight which is happening between two armies. This is now much bigger than them, right? Now, when that happens, obviously then Israel and US are on the back foot, right? And when they're on the back foot, then there is obviously a certain assumption that if US decides to sort of send troops there, then this sort of escalates to a much larger level where even Russia might get involved. And suddenly, then we are potentially looking at a much bigger scale of war, which could potentially lead to a catastrophic event as big as, for example, like a 2008. I'm not saying that those verticals might be the same, but in terms of the impact that it might have on the global economy, like the Strait of Hormuz, the crude oil price going up. Like now, for example, if India's story is also different, but India's context within that is very, very important because we don't have like 25, 50 days of crude oil with us as reserves, right? So if let's say, so potentially what I'm saying is if World War III was to get engaged, then ideally what kind of scenarios are we looking at?
So, see, obviously that's like a very big question in the sense that very important and crucial question. By big question, what I mean. But 2 points, before I jump into that, 2 things I wanted to share. First is that if you see the market, practically every year or other year, it goes through a mini crisis. So if you look at Nifty, maybe long range compounding is 13, 14, 15% compounded. But almost every year from its high point, it declines in the range of 10 to 15% or sometimes 20%. There is practically no year where Nifty has not fallen double digit from its previous high. And instead of Nifty, if you look at small cap and mid cap, small cap index, there is practically very normal for it to fall 20-25% from its high point.
Right.
So what happens is that while we remember COVID and global financial crisis and the internet bubble, and some might remember even 2013, what we call taper tantrum. The thing is that those are big events we remember. But apart from that, in any case, if you're invested in equity, double-digit fall in any given year is something which you should be mentally prepared for. That is one. Second important thing is that if you now, come to, let's say, changing world order and US, I understand, where it is coming from. And there are a lot of, in the book also, Mr. Dalio has put a lot of parallels of how past empires, right from Spain to Britain to France and Portugal, and so many of these have gone, risen and then
like the reserve currency, global reserve currency has changed every 100 years.
But couple of things. I mean, I'm not an expert at this, but 2-3 things that we should keep in mind in terms of the current context. That the US is still not the biggest economy, not just the biggest economy, also the biggest technology superpower and the biggest military superpower. And what goes along with all this is also the biggest media superpower, in terms of ability to control narratives and in terms of influencing narratives also, all of those. The other important thing is that precisely to delay the world order or to hold back the world order, whatever, whichever way you look at it, is precisely why energy sources and oil is what is being aimed at, right? I mean, it's not coincidental that first it is Venezuela and then it is Iran, correct? Third thing is that obviously Russia also wants to sell oil. And, so it is very difficult today to frame the world in terms of old framework like, US is on one side, Russia is on the other side. I personally think that it is, multipolar, and also some of these relationships are quite complex. They are not as black or white as what it used to be in the past, right? So what is happening is now, say for example, if you see India's position, we are not in any camp. I mean, we are buying Russian oil, but our biggest industrialist, Reliance Industries, is building a refinery now in US, right? And it is widely acclaimed that Reliance is one of the few, or maybe the only one, which can process the Venezuelan oil, because the US refineries are not fit to, they refine sweet crude, whereas this is heavy, So and obviously Reliance has the highest or the best available technology for all of this, right? So my sense is that if you really go back to, US getting stuck with this whole Iranian conflict, the point is that even Saudi, for instance, needs to pump oil, otherwise their economy goes into trouble. I mean, all of those guys, everybody needs to sell oil. Even the US needs the oil industry to flourish. I mean, there is, so I think compared to 100, 200, 300 years back, economic interests are kind of ruling supreme, and the world is dominated by economic interest and dominated by corporate interest in that sense. So corporate interest, stock markets, the economy, the economic aspects of this is probably much bigger than what it was 100, 200, 300 years back, right? And I was recently reading this framework which says that most leaders, ultimately all of this is done by certain leaders.
Right.
Most leaders have an instinct for survival. And most leaders will do what will keep them in the seat, correct? So I am not an expert at all, but I personally feel that they will try to control the narrative, and I don't think you will see these guys fighting this for, maybe if you meet me 1 year later, I don't think we'll be in the same situation. I think there'll be some effort to extricate themselves from the situation, to control the narrative, to pronounce a victory, and to, just gain control of resources, but otherwise, diffuse the, install a particular regime which operates in a certain way and control the narrative and extricate from the situation. So I personally, yes, I know, I can completely understand why everybody's talking about world order, and I'm not, it's not like I can't understand, but I feel that it is seemingly too extreme.
Right.
And I feel that the world is slightly different from what it used to be a couple of 100 years back.
Got it.
Plus, there are not many alternatives. US is still, in all the facets which I told you, is still the biggest superpower.
Right. So, now let's look at these events, or because if we take example of somebody like a White Oak, because they're obviously globally also, they're a very big firm and they manage a lot of AUM. How has White Oak over the years sort of looked at these events and sort of readjusted themselves, or what have they done for investors specifically during these periods?
Correct.
So if you can share a bit of a light on that.
So Vishwas, what happens is that, there are two ways to look at this. There is, at least at White Oak, the belief is that a lot of these macro events, you cannot predict or forecast the macro events. And I would say, yes, there are some people who claim, and probably some people may have track record of having forecasted some macro events. So one can't grudge them their success. But the point is like this, that where it gets complicated for money managers is that not only you can't successfully predict macros, but what confounds it even further is that you can never predict how market will respond to the macros. I think that is the second level of complexity, correct? Like just now we were discussing that so many things have happened, but the market is not.
Right.
Right? So I'll give you a couple of examples. In Feb 2020, if somebody told you that, look, now you are going to have the biggest pandemic in human history, you all will be locked up in the house for 6 months, market will drop 40% in a month, and there'll be billions of dollars of selling, etc., etc. You would have liquidated a portfolio and sat in cash. Forget cash, you would not even keep it in the bank. You would literally put cash under your pillow.
Right.
But that would keep you happy for exactly 4 to 5 months, because before the year ended, market was making new highs. You would want to summon that guy back, that whoever told me to exit in Feb 2020 never told me to buy it back in April 2020, right? So what I meant to say is that COVID was not predicted, but even if you predicted COVID, how the market would respond to it, that is what actually is the key thing for us. So what we do actually is that we, in our own understanding, our framework is that we cannot predict or forecast the macro. So we will never tilt our portfolio in any direction expecting a certain macro to play out. The second thing why we can say such a thing is because we are ultimately an equity manager, which is that, people who give us money, they give us money with the intent of investing in equity. So the asset allocation decision, the choice that I will be in equity and whatever goes along with investing in equity, that choice is already made by the wealth manager, private banker, or the end customer before the money lands up on our table. So the money which lands up on our table is to be invested in equity, and hence within equity, our objective will be to beat the benchmark. Now what will happen is, if you see all the mutual funds that we manage, we run what is called a balanced, factor balanced, style balanced, sector balanced portfolio, meaning that if BSE 500, look, a lot of people say that for this particular macro event, I think export-oriented companies will do well. So let me overweight exports. If that macro event doesn't play out appropriately, or if the market doesn't respond as expected, then instead of export-oriented stocks, it might be the importers which might play out, right? So what we say is that I'm not going to bet on the rupee moving either way. I'm not going to bet on export oriented or import oriented. The benchmark is such that it has a mix of both. So my portfolio will have a mix of both. Because what we will do is that at a style level, at a sector level, and at a factor level, we'll try to make sure that our portfolio is balanced versus the benchmark. But our portfolios are 60 to 70% active, which means where the portfolio is different is only at a stock specific level.
Right.
So the stock picking is very different from the benchmark, but at a surface level, these sectors, factors, and styles are reasonably balanced. I'll give you a more staggering example. If you see, there are times when people say that growth stocks will do well, and in last 4 years it is value.
Right.
If you're a bottom-up stock picker, you might end up buying free cash flow, return on investment, return on invested capital, good governance, etc. But the benchmark doesn't have only such companies. Benchmark has companies which run on commodities also, order books also, public sector, private sector, everything. Right? So what will happen is that you must have seen winners keep rotating.
Right.
If growth does well, one type of fund manager does well. If value does, another guy does well. You can't predict when it will be growth, when it will be value. And plus, we have to beat the benchmark. The benchmark is half growth, half value.
Right.
Almost, right? So what we will do is that we'll balance our portfolio for all such considerations versus the benchmark. But at a stock specific level, we will be 60% different from benchmark. So people who studied finance in their college, they might say that as far as our portfolio construction is concerned, the market risk or the systematic risk, that is balanced. The only risk we assume is the non-systematic risk, which is the stock-specific risk. And the stock-specific risk also, by the way, we diversify through a very granular approach. So we are managing the portfolio for consistency, good information ratio, and low volatility. When people start forecasting macros, if they go right, they'll get a very high alpha. If they go wrong, they're outside out of the game completely. So we don't want that kind of crazy experience for our clients.
Right. Yeah, I think the philosophy here is that protection of capital also matters a lot, not just returns. So yeah. So I'd like to go back to our discussion that we were having, and I'll like to specifically talk about the Indian context. Now, if we remember post 2014 when this government came in, a lot of people used to wonder that all the visits of the Prime Minister going to the foreign nations at the time, that he's visiting even small countries like Bhutan to Nepal, to even obviously the bigger countries in the West, right? Do you think that has played out really well for India? If we look at the current, because even though we're talking about that Indian markets have been sideways from last 1 or 2 years, but if you look at the global markets, they've generally been negative, or they've not been able to sort of even have this resilience what we have had. And our geopolitical, because the good thing that is being talked about India is that India seems to be everybody's friend, whether it is Russia, whether it is US, whether it is Iran or Israel, right? So do you think that this base that has been set has sort of, because one thing very clear that the foreign investors look for, all the FIs have not been very much active in India right now, and that has its own reasons. But the stability is what a foreign investor or even a good corporate looks for. So do you think that this has sort of played well, that we have played our cards well in that direction?
Yeah, see, I think what is interesting is that clearly in the last few years, we've heard from our own government and the senior politicians that, it's not, the world is not bipolar, or there are no poles.
Right.
India, if you want to look at it that way, India is a pole itself. Or it is that, you have also seen a series of bilateral trade agreements.
Right.
Because 30 years back, like when I was in school and college, we used to hear about WTO and what negotiations happened. And before that, they generally accepted trade and tariff principles, GATT. Right. So right through our school and college days, we used to keep hearing about GATT and WTO and all of those. And I think till it suited the big powers, they followed that framework. When it stopped suiting those big powers, then those frameworks were consigned to dust, and it all became bilateral. If you help me, I'll help you. Right? There is no, so a lot of these multilateral agencies are being relegated to the backstage, and it's become more bilateral. So in that sense, if you really see, not being aligned to any one pole is obviously turning out to be right, you know. And even before all of this played out, you saw India doing a series of bilateral free trade agreements with Australia, with UAE, then with England, UK, and Europe, and now US, and so many things playing out. So yes, definitely that seems to be helping us not to be in any camp. Also, you must have seen this very interesting speech. The Honorable Prime Minister of Canada, for example, Mr. Mark Carney. His speech in Davos, it became very popular, right? In that he said that the world order, the way it was probably not as authentic as we believed. It was maybe opportunistic, right? We had a lurking fear, but we had a lurking doubt, but we didn't accept it that way. But it has turned out to be opportunistic, right? That's what he said. And then recently I was seeing an interview where somebody asked him that when you came to India, what did you notice? So he said that India, especially our Prime Minister, for the kind of thing that he spoke as a realization in Davos, somebody in India would have said, so what's new? We knew it all along. Right? The world order that you are talking about was opportunistic and was beneficial to some, beneficial to the Western world, and not so beneficial to some. That has been evident to a country like India for decades together. I mean, for you, it may be a new realization. So I think all of these things, if you really ask me, is playing out. And plus, of course, two more things to keep in mind. It's written somewhere, and many people have said that demography is destiny. So what has happened is that the world is likely to be more invested in us. And the world is likely to, any which way, want to work a lot more with us because of demography. And apart from these 2 points, the third point is obviously our government has also been at the forefront in terms of reforms, in terms of digitization. A lot of those things also happening when, this all of this is kind of a confluence of many things, which makes one kind of optimistic about times to come.
Absolutely. And if let's say we were to, go back, sort of not go back, but given that, yes, people might have sort of had this negative stance that, market has been sideways, but we all know that it's always a moving market. Markets always tend to go up, and investors have, at a large period of time, people have always made money. But what are some of the things that make you really excited for India, like in the next maybe 5, 10, 15 years? And what are some of the risks at the same time that you see it sort of, which you feel might concern you? And so if we can talk about both the sides.
So a couple of things. See, first is, Vishwas, as you must have also seen, and a lot of your viewers may have seen, that starting point really matters. Let's say talking about 5 years return, the fact is that starting point is very important, right? Because if your starting point was March 2020, then from there, where did the market go next 3 years? It didn't matter. You were always in the money. But if your starting point was October 2021 or November 2022, when Nifty was nearly 19,000 on both those occasions, then, so 3-4 years have passed and you are at 23,900 or 24 or whatever it is. So starting point always matters. And from that perspective, for your question, I think I'm very happy at the starting point where we are. Because we have, like we already discussed, at Nifty level, we've been flatlining for 1.5 years. And broad market, of course, we are double digit down. But from the point in time when Nifty was at its all-time high in 2024, from there till now, when it is flatlining or broad market is negative, but in that intervening period, many things have changed. First is that in 2024, we were speaking, maybe September 24 quarter, we spoke of 5.4% GDP growth, practically zero earning growth, very tight RBI policy, and a government which was out of action because of elections and coalition and then, government formation. 1.5 years down the line, we're not talking 5.4%, we're talking closer to 7% GDP growth. We're not talking very high corporate earnings, but definitely we are talking high single digit, low double digit kind of number. Sovereign rating is upgraded. RBI's thrust on growth definitely has changed. And as far as government is concerned, it's back in full force. I mean, they are boosting, like cutting taxes, rationalizing GST, announcing a very large 8th pay commission, also giving out incentives, or you may call it freebies. In every state election, we are doing that. So I think that in terms of nominal GDP growth, in terms of earnings, so I always tell people you should visualize market like a spring, because if the prices are not moving, that means the spring is being compressed. And in the intervening period, if earnings and GDP numbers are rising, it means that the spring is being compressed, but it stores more and more energy. The more you compress a spring, if it doesn't lose its physical dimensions, it stores more and more energy. So now for 1.5 years, the spring is being compressed. The external macro is adding to the uncertainty. That is why we are still flatlining, right? But I think that this is a great starting point, because I think from here, anybody with next 5 years kind of horizon stands to make very good returns. Generally, what happens is that every time such a thing happens, it always looks like a end of the world scenario. It looks really horrible. But you will never get a correction for reasons of your liking.
Right.
You have to take it when you get it, right?
Yeah.
And I think that whatever is changing, look at it this way. For 15 years, the US has been on a tear. 15-year return in dollars for US was about 15% compounded before this correction started. I mean, if US is delivering 15% compounded, why should anybody invest in emerging markets or India or wherever else? Correct? So the impetus may be credit crisis, the impetus may be a correction in AI stocks, the impetus may be energy prices and Middle East. Whatever the trigger or impetus may be, ultimately, if globally markets correct or if US market corrects, we will, in 18 months we have become cheaper. The currency is down another 8-9%, and we have underperformed other emerging markets by about 30% because of this whole AI related thing. So I feel that globally, if markets correct, when the dust settles, at least for India, you will see a rip-roaring rally. I won't be surprised in the next 2-3 years.
Got it. And what are some of the risks?
Oh yes,
that
of course.
you see?
So you see a couple of things. One, like I mentioned, when you were talking about the Middle East, I mentioned what I think can happen, but it would be foolhardy to say it is not a risk, because, for example, like I was mentioning, that ultimately all of this is related to energy. Ultimately, leaders want survival. They would want to install some kind of regime and back off, etc. The point is that we have to all be thinking in probabilistic terms. There may be certain probability assigned to what I'm saying, but there will always be a lurking probability that there will be a prolonged thing, the kind of fear that you were expressing. So as we stand here, that looks like a risk. The second thing is that so far so good. When you mention foreign policy, bilateral, the way the government is conducting things in a very challenging environment. So I think sustainability or sustenance of leadership and sustenance of what we are doing, because what is happening is, clearly I have seen that in the last few years, the macro is becoming more and more volatile and more challenging. So from that perspective, stability and sustainability of domestic politics, I think that is very, very important to keep us on the path. Rest, I think, is all cyclical. See, I don't lose sleep over index going up 10% or going down 10%. That one has seen happening practically every year or the other year. So I won't pay much attention to cyclical stuff. But definitely, whatever we've been discussing about the external environment is a source of risk. There's no doubt about it.
Right. And lastly, to sort of sum this up, what advice you would like to give to retail investors that generally when there's a lot of uncertainty or you can't decide, how should one navigate their portfolios, or is there even a need for navigation?
See, I think what I feel is that it's a great discussion to have and, try to throw light, like, you share what you think or I share what I think, and hopefully we add some value to help people to think better maybe, right? But what I would say is that whether it is you or me or anybody, nobody should be deterministic. I tell people that, only dead people can be dead sure. Rest, everybody has to be open-minded and probabilistic in their thought process. Right? So sitting where you and I are sitting, you ask me, in all honesty, I will tell you what I think is likely to play out, because nobody wants to live in uncertainty. So some guidance is in order. But I don't think whether it is your guidance or my guidance, nobody should bet the house on any guidance. The point is that you should be probabilistic. If you believe what I'm saying, then I think you should start overweighting your equity positions right now. Yeah. If you believe in the worst case, then also you cannot make equity zero. You can only calibrate down. Because the probability that I am right, let us say maybe 60-70%. But the probability that the counter view may play out may be also there 20-30%.
Right.
Correct? So can you bet 100% on something which essentially has probability of 70%? Or can you bet 100% on something which essentially has probability of 20-30%? So what happens is that successful investors should be open-minded, they should be probabilistic, they should be able to, what I call, thrive in gray. I think I am well positioned to say that because I'm wearing gray.
Right.
But people should be open-minded and probabilistic. Only open-minded and probabilistic people can do asset allocation. And if you're convinced of a scenario playing out, then you will just recalibrate your asset allocation, but you will never swing for the fences.
Right.
You should never be 100% betting on this or 100% betting on that.
Right. Absolutely.
You should be in a position where you calibrate up or down and leave your portfolio in a position that it doesn't get thrown out of the field even when something unexpected happens. The prize is for staying in the game. Never do anything whereby you are
Out of the game.
thrown out.
Yeah. Thank you so much, Aashish. This was wonderful. Thank you for sharing your insights today. I hope viewers, you liked what Aashish had to say today. Do tell us in the comments the points that you liked, and maybe you can ask even certain questions. We would like to answer them as much as possible. Thank you so much for tuning in.
Thank you.